Welcome to the video. Today we'll expose how seemingly small investment fees, like 1% to 1.35% annually, can silently destroy long-term returns. We'll also show you practical, step-by-step ways to move to low-cost platforms and funds without triggering taxes, plus a simple checklist to act today. Let's begin. Here's the agenda. First, we'll cover why fees matter. Next, we'll quantify how a 1% to 1.35% fee drags compounding over decades. Then we'll compare performance against sensible benchmarks like the S&P 500 after fees. After that, we'll highlight low-cost index ETFs and platforms, and explain how to move accounts tax-free or in kind. Finally, we'll summarize actions and test your knowledge with a quick quiz. Even small fees reduce your net return every year. That lower return compounds into a smaller base for future years, and over long horizons the gap becomes massive. This flowchart shows how a fee leads to lower net returns, which reduce yearly growth, then shrink the base for the following year, ultimately causing a huge lifetime shortfall. Now we'll put real numbers to it. Let's quantify. Suppose your portfolio's gross return is 7%. If you pay a 1.35% annual fee, your net return is 5.65% on $100,000 over 30 years. Compounding at 7% yields approximately $761,000. Compounding at 5.65% yields approximately $520,000. That's a gap of roughly $241,000. Over 40 years, 7% grows to about $1,497,000, whereas 5.65% grows to approximately $902,000. The difference is around $595,000. These figures are illustrative and rounded, but they capture the scale of harm. Recurring percentage fees compound against you and can erase hundreds of thousands of dollars over a multi-decade horizon. On the left is a high-fee setup. 1 to over 1% in annual advisory and fund expenses, often justified by complex narratives for simple buy-and-hold strategies, with performance that rarely exceeds benchmarks after fees and friction that reduces compounding. On the right is a low-cost setup. Minimal ETF expense ratios in the range of a few basis points, diversified index exposure, transparent, automated contributions, and more of your return kept to compound. The investment exposure can be similar, but the cost structure, and thus the outcome, differs dramatically. Now evaluate the past objectively. Did your portfolio consistently outperform an appropriate benchmark such as the S&P 500 or a blended index after fees and taxes? For most retail investors, the answer is no. While behavioral coaching can be valuable during market turmoil, ongoing high management fees are seldom justified for basic diversification and buy-and-hold investing. If you want advice without perpetual drag, consider fee-only, flat fee, or one-time planning services. Here are the steps. First, identify all costs, your advisory fee, each fund's expense ratio, and any trading or platform fees. Next, open a low-cost brokerage account. Then choose diversified, broad market passive ETFs, such as total U.S. equity, total international equity, and core bonds appropriate for your risk. For tax-advantaged accounts like a Roth IRA, request a direct custodian-to-custodian transfer to avoid taxes and penalties. For taxable accounts, request an in-kind transfer of assets so you don't sell, and trigger a capital gains event. Once transferred, set up automatic monthly contributions aligned to a simple target allocation, and plan to rebalance periodically, for example once or twice per year. Keep records, and verify that all positions arrived correctly. This table illustrates approximate outcomes on $100,000 at a 7% gross return versus 5.65% net after a 1.35% annual fee. After 10 years, about $196,700 versus $173,200, a difference of roughly $23,500. After 20 years, about $386,900 versus $300,300, a difference of around $86,600. After 30 years, about $761,200 versus $520,000, a difference of approximately $241,200. After 40 years, about $1,497,400 versus $902,000, a gap of roughly $595,400. These are rounded, illustrative figures, to show the order of magnitude of fee drag over time. Here's a simple roadmap using Markdown. The key formula is net return equals gross return minus all-in annual fees. A moderate risk example allocation might be 70% total market equity across U.S. and international, and 30% in core investment-grade bonds. For maintenance, use plus or minus 5% allocation bands or set semi-annual rebalancing intervals. This pie chart conceptually shows three portions after 40 years, starting from $100,000. The no-fee scenario at roughly $1, $497, $400. The after-fee scenario at roughly $902, $000, and the difference of about $595, $400, labeled as wealth lost to fees and fee drag. The visualization highlights how substantial the cumulative impact of ongoing fees can be over a long horizon. Quiz time. Question: if your portfolio returns 7% before fees and you pay a 1.35% annual fee, what is your approximate net annual return? Options: A. 7%, B. 5.65%, C. 8.35%. D. It depends. Fees don't affect compounding. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 5.65%. Net return equals gross return minus the fees. 7% minus 1.35% equals 5.65%. Second quiz question: which method moves a Roth IRA to a new brokerage without taxes or penalties? Options: A. Sell everything and withdraw to your bank, then redeposit again. Direct custodian to custodian transfer. C. Take a 60-day rollover with a physical check. D. All of the above. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is direct custodian to custodian transfer. This method moves assets institution to institution without you taking possession, avoiding taxes and penalties for Roth IRAs. For tax-advantaged accounts like Roth IRAs, traditional IRAs, and HSAs, use a direct custodian-to-custodian transfer. For taxable accounts, request an in-kind transfer so you do not sell positions and create an immediate capital gains tax event. Keep accurate cost basis records and confirm that your tax lot and dividend settings transfer correctly. If you need to adjust holdings after the move, consider migrating into low-cost ETFs gradually to manage taxes. It's fair to acknowledge that some advisors add value through behavioral coaching during market stress and by handling complex planning. However, for long-term, diversified buy-and-hold portfolios, high ongoing fees are rarely justified. If you want guidance without continuous percentage fees, consider flat fee or hourly planning for specific, time-bound needs. These are your action items. Inventory all fees. Open a low-cost brokerage and choose low-cost ETFs. Use direct custodian-to-custodian transfers for tax-advantaged accounts and in-kind transfers for taxable accounts. Automate contributions, maintain a simple allocation, and rebalance on schedule. Benchmark after fees against appropriate indices, and continue minimizing expense ratios. This content is educational and not financial, tax, or investment advice. All investing involves risk, including potential loss of principal. Past performance does not guarantee future results. Consult a qualified professional who understands your specific situation before implementing any changes. To wrap up, small recurring fees create very large wealth gaps over decades, so minimize them now. Use direct transfers for IRAs and in-kind transfers for taxable accounts. Favor diversified, passive, low-cost ETFs, and automate contributions. Benchmark after fees, and remember that complexity rarely beats the market over the long run. Thank you for watching. If this was valuable, please like the video, share it with someone who needs to stop paying high fees, and subscribe for more simple, evidence-based investing content. In the comments, tell us, what fee did you discover, and what's your plan to cut it this month?